situation and our approach to the COVID-19 crisis, an update on the state of financial markets and the effect on portfolios, the importance of your strategy and maintaining it, the role of central banks and their response to the crisis, and of course your key questions, which we will certainly try to get to as many of them as time permits. Now, this discussion does contain general advice, and your personal wealth advisor is on standby to assist you with any questions or concerns relating to your personal circumstances. Now, it's a pleasure to welcome our panelists for today. Founder and CEO of Capital Partners, David Andrew, Head of our Investment Committee, Michael Matthews. A special welcome to Graham Lennon, Independent Consultant to the Investment Committee. Graham, having been a global portfolio manager for many years with Dimensional Fund Advisors, one of our investment partners in implementing your investment strategies, and Principal and Wealth Advisor, Catherine Creasy. Welcome to you all. Now, David, could you get things started for us with your view on the current crisis and how this differs from the GFC?
Thanks very much, Damon. My role this afternoon is very much to provide a broad overview of the topics we'll be covering today. But I first want to acknowledge that this is a particularly challenging time for many people in our community, and we are all feeling the pinch in one way or the other. Thinking about this, on the one hand, we've got people like me who are concerned about our parents and our in-laws, and I think on the flip side, we've got lots of parents out there pushing back on being told what they can and can't do by their adult kids. Similarly, we've got active young children cooped up and teenagers being confined to barracks over Easter, so I don't envy any parents out there. Let's begin. Capital Partners operates where money and life intersect. So we're having a lot of conversations with our clients around how these events are impacting them, and our hope today is to provide you with some context around what's going on in financial markets, the economy, and the world for that matter. The COVID-19 pandemic certainly is unprecedented in our times, and the world is charting a new territory in response to it. It seems that we in Australia have acted in time to avert the terrible human cost that we've seen elsewhere. There's no doubt we're living through a really important chapter in history. The economic cost of this event is yet to be calculated, but I do want to spend a little bit of time on just how we at Capital Partners are thinking about this. Firstly, it's only human to feel a bit stressed and anxious at a time like this. Humans crave certainty, and it's not often we're faced with this kind of complexity and uncertainty. When it comes to markets, I've been doing this for about 30 years, so I've seen a few ups and downs. I can certainly understand how people are feeling at the moment when they turn on the news at night or open the newspaper. And Michael will be spending some time speaking about markets. And I just want to kick the conversation off with an acknowledgement that markets are responding much as we would expect in the face of such uncertainty. But it's also really important for us all to acknowledge that this episode will pass. My next point is that you do have a plan. We talk a lot about this in our meetings with clients. We didn't see this particular event coming, but every client has a financial plan built with this kind of market downturn factored in. But I do want to acknowledge that some of our newer clients might be feeling this more acutely because you've not been through this with us before. But we're very confident that your plan is built on sound, evidence-based principles and that you can afford to look through this volatility rather than reacting to it. My next point is that this is not the GFC. While it's really serious, this is a health emergency with severe economic impacts rather than a financial system emergency, and that makes it very different. Michael again and Graham will talk more to this. The market volatility relates to the uncertainty over the length of the shutdown, and Graham's going to talk about the proper functioning of markets and what's reasonable to expect as we emerge and rebuild. I do want to commend you on how resilient you are being in your decision making, because in a crisis it can be really tempting just to do something. You know, having taken a systematic approach to your planning, I commend you on your discipline in its implementation. And my final point is about capital partners. And I know that many of our clients have asked how we're going, and I really appreciate your concern. There are many people who rely very heavily on our advisors and our advice teams. So I just want to say a few words about how we're placed to weather this crisis, in doing so to make sure that we're here for you. Just as we expect our clients to have a plan, so do we. We learned from our experience in the global financial crisis to run a very tight and conservative ship. So we've come into this event with significant reserves and a very, very strong balance sheet. Our expectation at this stage is that we can operate on a virtual basis like this for quite a long time. And in the last 2 weeks, we've been pleasantly surprised at how willing our clients have been to embrace these new technologies and forms of conversation. We were also very concerned for the health of our team and their families. So we moved very early to a work from home model to keep everybody safe. One reflection is that I'm now really grateful for the fact that we had our cybersecurity scare some 18 months ago. At the time, we were really transparent about it, but between you and me, it was terrifying. At the time, we were horrified, but the silver lining has been that our technology strategy and our investment since then has been really significant. And this has meant that we've been able to have a rapid, secure and productive deployment of a remote office really quickly. While in the background, our network and all of our traffic is monitored 24 hours a day, 7 days a week for any security breach. So I sleep at night knowing that in this sort of remote environment, our clients are secure. And for this, I thank our incredible operations and IT team. So I trust my opening comments have given some context, not only to what we're going to talk about today, but how we're thinking about this crisis. And now I'll pass back to Damon for the next section.
Thanks so much, David. Michael, can you provide us an update on financial markets and what this means for all of us as investors?
Good afternoon. Two key themes that I wanted to cover off today. The first of which is understanding as best we can, the current market conditions and the causes of the quite extreme volatility. And the second thing is looking at the integrity of the portfolios and looking at how robust they are and why it is that as investors, as advisors, we remain very, very confident in the investment managers and the portfolios that have been recommended and put together for you. So the first thing that I want to cover off is what we are seeing in financial markets, this extreme volatility, is entirely as we would expect in the face of such uncertainty. While the volatility is quite extreme, in particular when we think of the share markets over the last few years, we had a drop-off of 15% or so in 2018, and then we had a strong rebound in 2019. And then with COVID-19, we've now seen a 15% decrease in the last 12 months, of which we've seen 26% decline since late February. And yet in the last fortnight, we've seen a 15% increase in financial markets. Quite extraordinary. So what's behind this volatility? What's causing the markets to whipsaw like this? Essentially, it is about uncertainty. It is about financial markets responding to both new information as it is being released and the lack of information. There is a concept called price discovery, and in volatile times, it is very difficult to do. Price discovery is the process by which we understand and we forecast future cash flows and the operating potential and profitability of various businesses. And with the uncertainty of COVID-19, no one really knows what the medium and longer term impacts will be, and how long lasting these impacts will be. So therefore the uncertainty. And it gives rise to the frightened selling and the confident buying. It makes me think of a lovely quote by Mark Twain, who said, "I am an old man and have known a great many troubles, but most of them have never happened." It is almost certain, though, that we are headed for a recession, and that is successive quarters of negative growth. And yet, unlike the global financial crisis, this is a supply-based recession, essentially when the supply of goods and services is restricted or halted. It's not a demand-driven recession as was GFC. What's the good news here? Well, if history is a guide, supply-driven recessions tend to recover sooner. And the forecasts that seems to be a consensus at the moment is that we may well be through this on average with 6 quarters, and that is in 1.5 years' time. I think we can take a lot of comfort, actually, from the very well coordinated approaches, the stimulus packages of governments and central banks in the developed markets. And that is that the highly accommodative monetary and fiscal policies that we've seen, these stimulus packages, have very much worked to ensure that there is liquidity in the system, solvency is maintained, essentially keeping businesses open and employees in jobs. So let's take a minute and talk about the portfolios themselves. As you have heard from your advisors and various presentations that we've done over time, the portfolios that we have recommended and constructed for you, whether it be with shares, fixed interest, property and so on, have been constructed having regard to market volatility and down markets that we are currently experiencing. We're not quite sure what the cause of the down markets are, it's just that we are prepared for them. Within the portfolios, across all investment managers, there is a very high level of diversification of the securities within those portfolios. There is a high level of liquidity. There is a very high level of dynamic trading. One of the most important things that we're looking for in the investment managers, beyond the diversification and the liquidity, which is the reason why there is so much security, is that we want to see that the managers are sticking to their efficient and dynamic trading processes. And at this time, we have not seen anything but sticking to well-proven processes that are efficient and taking advantage of the market opportunities as they present. Essentially, this means that the right shares and the right fixed interest securities that have the characteristics that we want in the portfolios are being acquired to capture the risk premium when it's available. And those securities that no longer have the required characteristics are being sold down. The managers, Dimensional and Vanguard in particular, are remaining open for business, and they are doing exactly what we expect of them during these times. Back to you, Damon.
Thanks for that insight, Michael. Graham, great to have you with us today. Could you provide an overview of the response from central banks, the likes of the Reserve Bank and the Fed in the US, and the importance of the stimulus they've provided?
Thanks, Damon. I'm happy to run through that for everybody. So we've all been watching lots of news recently and so on, and the news has been very full of information about the unprecedented measures our government's taking to provide money to businesses and individuals to get us through this crisis. There's less prominent than that has been information about the important role the central banks are playing to ensure that our financial system remains robust. And that's what I've just been asked to speak about. Around 3 or 4 weeks ago, as the severity of this crisis was becoming apparent, central banks moved very quickly to do several important things. You're probably aware that official interest rates were quickly moved to near zero all around the world to reduce borrowing costs. may not be aware of the probably even more important role that central banks played to ensure that the money and bond markets remained liquid and continued to function. As the equity markets were being hit, the liquidity in the money and bond markets was drying up. It was difficult to find somebody to buy a bond from you at anything like the fair value of the bond. Now, much of your defensive assets, these are the assets you rely on in a crisis, are invested in bonds. So the potential disruption to the bond market was a concern, and something the investment committee was monitoring very closely. The good news is that central banks around the world intervened very quickly, stepping in to essentially buy bonds in the market. And it worked. The markets returned to more normal liquidity within about a week. During this period, we were in close contact with the people managing your money, and the funds that you were invested in remained liquid. Managers were still able to sell bonds at sort of reasonable prices, but it was a lot harder than normal. Things quickly improved as the central bank's activities had their impact. Now, this central bank intervention we've seen, it is unusual, but it's not unprecedented. During the GFC, there were similar problems in both the money and bond markets, and these were ultimately resolved by the central bank intervention. This time around, having learnt from the GFC and other crises, central banks around the world moved quickly, decisively, and in a globally coordinated way. Now, as well as our central banks, the major commercial banks also play an important role in ensuring that our bond and money markets work. Now, during this time, I was chatting to a very senior banker, and he pointed out that his treasury team was really experienced. They lived through the GFC and other similar crises. They knew what to do. They were in close and constant contact with the Reserve Bank, and the Reserve Bank was listening to them and adjusting their measures in response to what was happening in the market. And I was very reassured to hear that. And we subsequently in the markets, we saw the very positive effects of that. On the 19th of March, David sent me a quite irresponsible article by a respected business journalist. And this article suggested that the Reserve Bank had lost control of interest rates, which, if true, would have been really bad. I pointed out to the committee that this was not the case. And indeed, the actions of the bank on that day had already had a significant impact on interest rates. I told the committee at that time that the job of the central banks was to resolve these potential liquidity crises, and we had to trust them to do their jobs. So far, they've been worthy of that trust, and I hope and expect that to continue. I'm an independent member of Capital Partners Investment Committee. The committee is seeking and considering appropriate evidence and making well-reasoned judgments to help Capital Partners clients through this volatile period. Back to you, Damon.
Thanks for that, Graham. Good to see such swift action was taken and appears to be working. Catherine, now all of this information needs to distill down to our individual strategies. Could you walk us through the importance of maintaining your plan, especially considering that we've seen such great ups and downs in the markets lately?
Thanks, Damon. Yeah, for sure. So now for all of you, I want to bring together what Michael and Graham have discussed to focus on what that actually means for you and for your plan. So all of Capital Partners advisors have been talking to you, our clients, and by and large, I'm sure what you've been hearing is that whilst the market volatility can be really anxiety inducing and hard to watch, if you stick to your plan, you are going to be fine. So we can liken the market to a roller coaster at times, and particularly now, it can be really scary. You don't know when the drop off will be, but what's most important is that you don't get off mid-ride. You hold on tight, you focus on a point on the horizon, and you know that it is not going to last forever. From time to time, in periods of volatility like this, we get questions from clients about selling out completely. So what we hear is that they want to wait and see how things play out, or they want to see what happens next. And invariably, it's really easy to pick a time to sell and to get out of the market, but it's much more difficult to choose when to buy back in. very few people have success in picking the bottom of the market. And if they do, it's usually by luck rather than by skill. So as David mentioned in his recent communication to you all, it's the old sell low, buy high, and repeat until broke. So instead of trying to time the market and get it wrong, we put a plan in place that you can that can work for you, regardless of whether the market is on the way up or down. And we know that you only lose money if you need to sell your shares when the market's down. So for all of our clients, we've built a specific plan with you, and what you need to do now is stick as closely to that as possible and focus on what you can actually control. For our clients who are retired or whose portfolios are solely or partially funding their lifestyle, we've been really clear over the years that we need to hold at least 5 years worth of your income requirements in defensive assets. And these are the ones that will hold their value in a market downturn. Now, Graham and Michael have touched on this, and we're really confident that your defensive assets are continuing to provide the security that you need to ensure that you can continue to draw the income that you need until the market recovers. So the most important thing at this time is that you don't spend more than what your plan allows for. We know that no matter what, some years your expenditure is going to be a little bit more and some years it's going to be a little bit less. This is one of those times when sticking to the budget or the little bit less is really important. Given the situation that we're in, I suspect this is actually a fairly easy goal to meet because there's not a lot to spend money on when you're stuck at home. Although I do understand that Australia Post and online delivery is doing a pretty roaring trade at the moment. For those of you drawing from superannuation, there has been a reduction in the minimum pension amount that you are required to withdraw. So our team are working on tax planning for everyone at the moment, and we are considering this for you. If you've been drawing more than you require simply to meet the minimum, we'll be getting in touch to look at reducing your payment and maintaining as much as possible in the superannuation environment, because as we know, there can be a significant tax benefit to keeping as much of your wealth as possible within superannuation. For our clients who are still working and building their wealth, what you need to focus on is really sticking to the plan at this time as well. So if you've got a savings strategy in place, as much as possible, stick to the savings plan and be speaking with your advisor about your investment strategy. I do understand that at this time for clients who are in the workforce or who are business owners, there can be some more significant challenges. There have been a number of measures that have been announced by the government that can provide support to you. So the specific JobKeeper and JobSeeker payments, as well as the potential to access your superannuation benefits. There's also the potential to negotiate with your bank on loan repayments and potentially take a repayment holiday. We're here to support you, so please make sure that you're speaking to your advisor if your income has been reduced. We can work with you to determine the best way forward, and we have a fantastic network of professionals who we work with, be that mortgage brokers, accountants, or lawyers, so we can facilitate conversations with the right people to help you make the most of the support that is available to you. And lastly, I just wanted to mention that for our clients with adult children who might be impacted by what's happening at the moment, or if you have friends who you know could benefit from some assistance, this is really one of those times where everyone needs to pitch in and help, and we are really happy to help. So please feel free to put them in touch with us. We'll have a chat, we'll help where we can, or we'll point them in the right direction. So at the moment, just staying in touch is the most important thing. Thanks, Damon, back to you.
Thanks so much, Catherine. So let's move to some of the questions that we've been receiving from our viewers. And it's been touched on through our discussion, but I think it's a really important point to emphasise is, Michael, many viewers, and I thank Craig and Karen for their initial question, have asked questions along the lines of, what is the effect on the bond market in this crisis, and how secure is the cash and our defensive assets in our portfolio?
Thanks, Damon. I think the best way to start answering this question, excuse me, is to acknowledge that in the same way that there is a broad range of securities in the share market with many different characteristics, from good quality companies to lesser quality companies. It's very much the same in the bond market. There are high quality investment grade bonds issued by governments and government authorities, and very high credit rated organisations. And then there are the sub-investment grade bonds. So as you would expect, as we've seen in the share market, in the fixed interest or bond market, we're seeing a very high level of demand from investors to be owning the high credit quality government issued and AAA and AA bonds. And there has been a relatively expected exodus from the substandard bonds. So we're seeing the price of the lower quality fixed interest investments dropping, and the result of that means that the return for the subsequent investors is much higher. The price drop in the high quality bonds has been very, very minimal, as you would expect, because the likelihood of the default in the good quality bonds is particularly low. So the question then is so how secure are the fixed interest investments that Capital Partners has recommended? Well, it should not surprise you and reassure you that the security is particularly high. The bond investments, the fixed interest investments, are there 4 times like this when you need to have access to capital to cover your cash flow requirements without the need to sell down the growth assets in a down market. Where does the security come from? Well, it comes from several places. Firstly, the liquidity within the fixed interest funds is particularly high, and that is that with the high quality bonds that the portfolios are invested in, predominantly AAA and AA rated bonds, there is a very active market. There is a very high demand from many investors around the world to buy these high quality bonds. So there's lots of liquidity, meaning that as and when you need to get access to the capital, you can do so. There is a large level of diversification, meaning that the maximum exposure to most of the bond issuers is somewhere between 2 to 3%, and in most cases though, limited to 1% of the portfolio being exposed to any one bond issuer. The term to maturity on these bonds is relatively short, which is also very important in terms of facilitating liquidity. And the final point I want to make is actually around the ratings and credit quality. Now, during GFC, what we saw was a level of defaults on bonds that the ratings agencies such as Standard & Poor's and Moody's had rated to be investment grade, but they were defaulting. The process that the managers that we have recommended for you follow, the process is not to rely on the ratings from the ratings agencies, which are often stale and occasionally inaccurate, but rather to base the transactions on how the market is seeing the credit quality of the bonds. And that is to say that a high credit quality bond is very liquid, there's a high demand for it, and the price does not vary greatly during these volatile times. Similarly, the lower credit quality bonds that may have been issued a high rating by the credit agencies, where currently the trading is quite volatile and the pricing or the prices are dropping, that would suggest that it is a lower quality than the rating agencies apply. And pleasingly, not surprisingly, the fund managers do not trade in those bonds in the high security component of your portfolios. So the security is high, the liquidity is high, the diversification is high, and the confidence that you as an investor can have is high.
Thanks for that reassurance, Michael. On the flip side of that, David, Tim has asked, when would be a good time to invest more cash while stock markets are down?
Isn't that the $1 million question? This goes to Catherine's point about, the similar but different in the sense that of should I get out now, sit on the sidelines and get back in later? It's really, really hard to know. During the global financial crisis, for example, there were 6 seeming opportunities. With the benefit of hindsight, any 6 would have been a good opportunity to get back in based on what the markets had done. And yet that fall, the first 3 of those opportunities would have actually been quite, devastating because markets fell further. It's really hard to tell. The view that our investment committee is taking is that this market sell-off, currently of the order of 30%, will in time provide some really good buying opportunities. For those clients who are coming to us with new monies, and there are quite a lot of people in that situation, our recommendation is to have a conversation with their advisor around a staged entry into the market. So you can imagine if you buy here, the market goes down a bit further, you buy here, the market might even go down a bit further, but it turns and you're buying on the way up as well. There is no perfect timing. The only perfect timing you can have is with the benefit of hindsight. So like everything we do, we take a systematic approach.
Thanks, David. That makes sense. Graham, we've often heard the media using this term QE. Could you let us know what that actually is and how central banks print money?
Thanks, Damon. That's a bit of a it's a question that's going to require me to go a bit technical. So firstly, we need to sort of talk about what is it that central banks actually do. So central bank's job is to manage what they call to administer monetary policy. And their main tool is intervening in the market to target specific interest rates. So if the central bank goes in and lowers interest rates, this reduces borrowing costs and stimulates the economy. So under normal conditions, they implement this through controlling money supply through their open market operations, which target the cash rate. In fact, these days, the RBA doesn't really need to do much intervention in the market to target its rate. It just announces the new rate and the market pretty well immediately reacts to that, because they know if they don't, the central bank will participate in the market to get the rate there. But the challenge, and this challenge has been in place around the world, various places for nearly a decade now, is when interest rates are really very low, reducing them further has little impact. So that forces central banks to revert to what is referred to as unconventional monetary policy. And quantitative easing is an example of that. And what that means is it's increasing the money supply by typically buying like a fixed amount of bonds across a yield curve in a particular period. So the central bank may announce, I'm going to go and buy X billions of bonds. And we've seen this at various times in the US and Europe since the GFC. The Reserve Bank's not actually doing typical quantitative easing. It's not really quantitative easing. What they're doing is what they call yield curve control. They're buying bonds in the market to target a specific interest rate on the 3-year bond rate. That interest rate's 0.25. So they come in and say, we're going to intervene in the market to hold the 3-year government bond rate at something pretty close to 0.25%. They're not buying a specific amount of bonds like in quantitative easing. They'll just buy the amount of bonds they need to do to keep that 3-year rate at their target level. So it's quite interesting. And they announced all of this on the 19th of March. And they announced a few things then, which I think gives us a bit of idea of what they're trying to achieve. So firstly, they reduced the cash rate to 0.25%. But importantly, they signalled that this rate's going to stay there for quite a while. So that we're not going to move this rate up until inflation gets back to 2 to 3% range, and suggesting that they think that's going to take, really suggesting several years. And they also announced they'll be intervening in the market to target the 3-year bond rate at this 0.25%. And both of these things are aimed at getting borrowing costs low. So to reduce borrowing costs for banks, who can pass those on to individuals and businesses. We should note that that this intervention targeting the 3-year rate was also the intervention that I mentioned earlier, which was providing liquidity to the bond market. So the activities of the central banks do achieve multiple goals, and in this case, it's been very helpful, certainly in terms of the liquidity sense, and it remains to be seen how helpful this will be in terms of encouraging people to borrow as we come out of this crisis. Now, you mentioned this concept of printing money, which is indeed a sort of a tricky thing to get your mind wrapped around. So the Reserve Bank it controls what is called money supply, which is literally how much money is out there. And like everything, the price of money is subject to supply and demand. So it's the Reserve Bank's job to adjust the supply of money to achieve the interest rates they're targeting. So if the supply of money goes up, they create more money, the price of money, that is interest rates, goes down. So the RBA is increasing the money supply by creating the money it's using to buy these bonds on the market. Now, this doesn't involve printing presses anymore. Literally, this is just an entry on a ledger. But it's a common thing that they do. Their job is to create and actually remove money supply to achieve their goals. It's just in what they're doing at the moment, the numbers are much, much bigger than they typically have been. And for the first time, the RBA is involved in some unconventional measures that are not only targeting the cash rate, but also targeting the 3-year rate. I hope that helps.
Fantastic. Thanks for that analysis, Graham. On the flip side of the technical side of things, Catherine, tying back to your earlier points, this can be both a really financial but also an emotional ride when markets have been like this. In your view, what are the most valuable steps investors can take in ensuring their wealth is preserved for the future in times just like this?
That's a good question, and very much like we were talking about before, in terms of preserving your wealth, it's really about sticking to your plan at the moment and not making rash decisions. So you don't want to be selling any of your investments while the markets are down, and certainly we've structured portfolios in that way, but it's up to you and your advisor now to hold tight and to manage your emotions so you're not jumping off that roller coaster. It's also really important, as I touched on, to keep the spending in check, which is really not potentially significantly hard to do at the moment, but making sure that your emotions don't get the better of you, and there's a reason why you have a plan in place. So you have to just sort of sit tight, I guess. It's a really tricky one at the moment to do, but that's why you've got all of this support around you.
Thanks for that sage advice, Catherine, and thank you to all who submitted questions. We do hope to get to future questions in further episodes. David, have you got some closing comments that you'd like to share with us?
Sure, Damon. Firstly, I'd like to thank people for attending. There's over 150 people online, and you can't see them all, but they're there out there in the virtual world. So we're delighted you could join us and hope that this has been useful. I want to leave you with 5 things. The first is that we're dealing with an uncertainty at the moment, and the team at Capital Partners is very focused on the things that matter and the things that we can control, and we're encouraging all of you to take a very, very similar approach. The second is that your own health and well-being and that of your families is the most important thing for you to focus on right now. So we absolutely believe that the money side of things will be okay, given the plans we have, and that we will ride this out. The third is that markets are, as Michael has said, behaving largely as we'd expect, given the extreme volatility. There's a lot going on behind the scenes with the government, the Reserve Bank and other governments and reserve banks around the world to be doing what they need to do to keep markets functioning properly. The fourth is that while we're not ignoring the possibility of further volatility still, we just want to reiterate that fact that you do have a thoughtfully constructed and considered plan to see you through. And finally, I just want to say a really warm thank you, not just to our clients, but also the network of other professional people that we have around us, the people that we would call our community. The goodwill, the cooperation, the collaboration that's been going on has been really, really heartwarming. It is a genuine honour for our team to serve in a time like this. We're grateful for the opportunity. And my final word is that from everyone at Capital Partners, we wish you and your families a very safe but different Easter, the holiday break. Back to you, Damon.
Cheers, David. Thank you for that. And thank you to all our panelists. And of course, again, to you for dialing into today's discussion. We hope it has provided you with some valuable information in plotting your course through current events. Thank you, and we look forward to seeing you at our future updates. Have a safe and happy Easter. Take care.